Will the market go up or down? Should you lock in or float? Find out this and more with Master the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Does your wholesale lender do this for you? Free customizable marketing materials, online loan tracking for your clients, returns your past clients to you, and complimentary client retention campaigns. Don't you think it's about time you found one that does? Partner with United Wholesale Mortgage and receive these benefits and more.
Hi, welcome to another edition of Master the Markets. I'm Barry Habib at MBS Highway, and this is created exclusively for Mortgage News Network. Another crazy week last week, culminating with this big referendum vote in Greece, where you'd have to consider it a landslide. Greece, the people of Greece, are saying that they don't want any reforms. So this means, and it's so interesting because the headlines say we're saying no to loan sharks. I don't know if you'd necessarily categorize a bailout as loan sharks, but still, the people being very resolved in not wanting to have any kind of reforms. And what does that mean? Well, we'll have to watch this very carefully now because they're out of money there. The banks are out of money. People have only been living on perhaps 50 or 60 euro a day. It's, whatever, $55, $65 a day that you could pull out of your ATMs. The banks have been closed for the past few days. It's a pretty scary situation. And going forward, if Greece is now going to be on a pathway to exit the Eurozone, of course, that's going to be a situation that's going to be pretty worrisome for the people of Greece. But how does it affect us and the global markets? Well, already we're seeing a negative reaction in stocks and a flight to quality into the bond market, meaning that interest rates, at least initially, are on the mend. They are improving here. Because whenever you see turmoil around the globe, they look for things of safety. And right now, the U.S. Treasuries, our mortgage bond market, the German bonds, these are things that are considered areas of safety and where people can really feel comfortable and confident. Stocks selling off around the globe right now. So we have to watch this situation carefully because if it is very messy with Greece exiting, have to start to think about other countries that are in difficult times and perhaps may be next. And what does that mean for the long-term solvency of the euro itself? Well, what we have to think about is this. Who gets wiped out in these situations? It's debt holders who get wiped out and also savers of Greece. If you didn't take your money out of Greece, you're kind of in a tough spot here because if Greece winds up getting their own currency, they're going to devalue that pretty dramatically. That's how you pretty much obliterate your debts, devalue your currency, and what you also gain by devaluing your currencies. Now your exports become a lot more attractive, so that does tend to help your economy over time. But still, it's going to be a very tricky situation. We'll have to watch this carefully. Last week, we did get the jobs report, and the jobs report was interesting because we got a reasonable number of job gains, looking for 230, got 223, but the unemployment rate looked pretty darn good, down to 5.3%, and that was a big improvement. And wow, you'd think our job market is really strong, right? Well, we like to look at the internals on this. You have to know that there's two job reports that you get from the Bureau of Labor Statistics, or BLS. One is called the Establishment Survey, which uses a lot of models, and that's where you get how many jobs were created each month. But the flip side of that is we also get a household survey. And there's about 60,000 households which actually receive phone calls and are surveyed on this. And this is where we get the rate of unemployment from. So let's just take a look here. I've broken down some of these numbers to go over with you. So first of all, the unemployment rate itself. So for May, this is the previous month before we got the number on Friday, we had 148 million and change here people employed. You divide that by the size of the labor force, which is 157 million, and that gives you your employment rate of 94.5%, which obviously the flip side of that is the unemployment rate. So this has to equal 100. So if there's 94.5% of people that are in the labor force are employed, then 5.5% are unemployed. But when we look at the household survey where this comes from, we actually lost 56,000 jobs in June. This was the report that we just got on Friday. So we lost 56,000 jobs in June. And when you think about it, if we lost 56,000 jobs, that means there's less people employed Divide that by the labor force, and wouldn't that give us an unemployment rate here of 5.6%? It would. So how did we get down to 5.3%? Well, let's see. We lost 56,000 jobs, but 423,000 people left the labor force. Poof, gone. Why did they leave? What are they going to do? I don't know. Are they on entitlement programs? It's very difficult to say, but this has been the state of affairs here. In fact, the labor force participation rate, in other words, the people in the labor force compared to those who can participate, is a low that hasn't been seen since 1977 at 62.6%. So let's go back to the math here. So we know we lost 56,000 jobs. That puts us at 148,739,000 people who are employed. But now the labor force shrunk from the previous month of May from 469 to 157,037, shrunk by 423,000. And that's what brought the unemployment rate down to 5.3%. Pretty interesting, obviously, to see this stuff here and how it works. And we oftentimes get these numbers, but we don't get the breakdown. That's one of the reasons why the bond market, although there was a pretty good report, we saw bonds actually improve. Now, it's a very quiet news week this week, and we will get some Treasury auctions and the Fed minutes. So when we get the Fed minutes on Wednesday, we get the 10-year auction on Wednesday. That could be a very volatile afternoon. And here's one of the things the Fed's going to be looking at. In the employment report, the hourly earnings actually decreased from 2.3% a year to 2% per year. That eased some inflationary fears. Inflation is the enemy of the bond market. So we actually saw some improvement in bonds based upon this. Look, it's going to be volatile. The situation in Greece is very fluid. We're going to get some auctions this week. We're going to get a lot of data that could move the markets. Fed Minutes always does. Why not get your free subscription to MBS Highway? Sign up for a free trial. And heck, we're in a big money business here. Subscribe. So affordable. Don't your clients deserve the best? Don't they deserve the best advice out there? Don't you want to be ahead of your competition? There's so much in here that will get you more business. Take a look at it, subscribe, and have a great week ahead. Bye-bye.
Today's Master the Markets was brought to you by United Wholesale Mortgage.
This is Mortgage News Network.